Look, I'm going to be direct with you. Something extraordinary is happening in the gold market right now, and most people have no idea it's even taking place. While the financial media keeps you distracted with stock market noise and crypto headlines, the world's most powerful institutions are quietly positioning themselves for what could be the most significant wealth transfer in modern history. And the clock is ticking. Let me paint you a picture of what's really going on behind the scenes. Central banks around the world are buying gold at a pace we haven't seen since the 1970s. We're not talking about modest purchases here. We're talking about unprecedented, aggressive accumulation that defies every conventional explanation the mainstream wants to give you. The numbers are staggering. Central banks have been net buyers of gold for over a decade now, but something changed dramatically in recent years. They're not just buying anymore. They're hoarding. They're stockpiling like they know something the rest of us don't. China's central bank has been on an absolute buying spree. Month after month, they're adding to their reserves. But here's what's fascinating. Many analysts believe the official numbers don't tell the whole story. There's strong evidence suggesting China's actual gold holdings could be significantly higher than what they're reporting. Why would they underreport? Because they don't want to trigger the very price explosion they're positioning for. Russia has been equally aggressive. Despite sanctions, despite economic pressure, despite everything thrown at them, they've been converting their dollar reserves into gold. They're not alone. Turkey, India, Poland, Singapore, the list goes on. These aren't random countries making random decisions. This is coordinated de-dollarization in action. Think about what that means for a moment. These central banks employ some of the smartest financial minds on the planet. They have access to data and intelligence that you and I will never see. They understand global monetary flows better than anyone, and they're all doing the same thing at the same time. They're buying gold like their currencies depend on it, because they do. Now, let's talk about what's happening on the supply side, because this is where things get really interesting. Gold production has essentially plateaued. The easy gold has been mined. The low-hanging fruit is gone. Every new ounce that comes out of the ground is more expensive, more difficult, and more time-consuming to extract than the last. Major mining companies are struggling to replace their reserves. They're spending billions on exploration, and they're coming up empty. The discovery rate for new gold deposits has been declining for years. We're not finding new world-class gold deposits like we used to. The geology simply isn't cooperating. What does this mean? It means the supply of new gold coming to market is constrained. It's not growing. In many cases, it's actually shrinking. Meanwhile, demand is exploding. You don't need to be an economist to understand what happens when demand surges and supply stagnates. But here's where it gets even more compelling. Let's talk about the paper gold market versus the physical gold market. This is crucial to understanding why we could see gold hit 5 figures sooner than most people think. The COMEX, the major exchange where gold futures are traded, operates on a fractional reserve system. For every ounce of physical gold in their vaults, there are multiple claims on that same ounce through paper contracts. It's essentially the same game the banking system plays with your deposits. As long as everyone doesn't ask for their gold at the same time, the system works. But what happens when confidence cracks? What happens when holders of paper gold start demanding physical delivery? We've already seen stress in this system. There have been moments when the spread between paper gold prices and physical gold prices widened dramatically. That's not supposed to happen in an efficient market. It's a warning sign. The London Bullion Market Association, the LBMA, faces similar dynamics. They're the other major hub for gold trading, and they operate on the same fractional reserve principle. The amount of gold traded on paper dwarfs the amount of physical gold that actually exists in their vaults. Here's a story that illustrates this perfectly. A few years back, a major European bank tried to repatriate its gold from storage in New York. They were told it would take 7 years to return their gold. 7 years. For gold that was supposedly sitting in a vault with their name on it. Why would it take 7 years to return something that's already yours? Because it's not there. It's been lent out, leased, hypothecated, and rehypothecated so many times that nobody knows where it actually is anymore. This is the house of cards that the gold market is built on, and when it collapses, the price adjustment is going to be violent. Let's look at some historical parallels because history doesn't repeat, but it sure does rhyme. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold because foreign central banks were draining Fort Knox. They saw the writing on the wall. They knew the dollar was overvalued relative to gold, and they were exchanging their dollars for gold as fast as they could. What happened next? Gold went from $35 an ounce to over $800 by 1980. That's a 2,200% increase in less than a decade. The dollar didn't disappear. The United States didn't collapse. But gold repriced itself against a currency that had been systematically devalued. We're in a similar situation now, except the scale is much larger. The amount of currency creation we've seen since the financial crisis makes the 1970s look quaint. Trillions upon trillions of dollars, euros, yen, and yuan have been created out of thin air. That money has to go somewhere. It has to chase something. For a while, it chased stocks. For a while, it chased real estate. For a while, it chased bonds. But now it's starting to chase the one asset that can't be printed, can't be created by central banks, and can't be devalued by government decree. It's chasing gold. Let me tell you about what happened in 2008, because there are lessons there that apply directly to where we are now. When Lehman Brothers collapsed, when the financial system was on the brink, what did central banks do? They printed money. Lots of it. They called it quantitative easing, but let's be honest about what it was. It was currency debasement on a scale never before attempted. Gold responded. It went from around $700 an ounce in 2008 to over $1,900 by 2011. It nearly tripled in 3 years. And that was just the beginning of the money printing. We've printed more money since then than we did during that entire period, but here's what's different now. Back then, central banks were still net sellers of gold. They were reducing their reserves. They believed the dollar system was stable. They believed they didn't need gold anymore. They were wrong. Now they're buying, aggressively. That's the signal. That's what you need to pay attention to. When the people who run the monetary system start hoarding the one asset they previously dismissed, you better believe something fundamental has changed. Let's talk about the geopolitical dimension, because this isn't just about economics. This is about power. The dollar's status as the world's reserve currency has given the United States enormous advantages. It's allowed us to run massive deficits without consequence. It's allowed us to sanction countries and cut them off from the global financial system. It's been the foundation of American power for decades, but that system is being challenged. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with several new members, are actively working to create alternatives to dollar-based trade. They're settling transactions in their own currencies. They're building new payment systems that bypass SWIFT, and they're backing these efforts with gold. This isn't speculation. This is happening right now. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting yuan for oil sales. That would have been unthinkable a few years ago. The United Arab Emirates is stockpiling gold. These are the countries that have been the backbone of dollar dominance, and they're diversifying away from it. What happens when the dollar loses its reserve currency status? What happens when countries no longer need to hold dollars to buy oil or conduct international trade? Those dollars come home. They flood back into the United States, chasing goods and assets, driving up prices. It's the nightmare scenario that keeps Treasury officials up at night, and gold becomes the neutral reserve asset. It's not Chinese, it's not American, it's not Russian, it's nobody's liability. It's the one asset that every country can agree on. That's why central banks are buying it. They're preparing for a world where the dollar is no longer king. Now, I want to take a quick moment here because this is important. If you're sitting on $100,000 or more in retirement accounts, you need to understand how gold IRAs work. I've put together a comprehensive guide that covers exactly how you can get physical gold into your retirement account without triggering tax penalties. It's in the description below. This isn't about fear. This is about having options. It's about understanding all the tools available to protect your wealth. Check it out if that's relevant to your situation. All right. Let's get back to the price trajectory, because this is where things get really interesting. Several major analysts have put out forecasts calling for gold to reach 5 figures. We're not talking about fringe commentators here. We're talking about respected market strategists with decades of experience. Ed Yardeni, a well-known market strategist, has forecast that gold could reach $10,000 by the end of the decade. His reasoning is based on continued central bank buying, geopolitical instability, and the ongoing debasement of fiat currencies. He's not alone. Other analysts point to the gold-to-money supply ratio. Historically, gold has tracked the expansion of the money supply over long periods. When you look at how much money has been created in the last 15 years and compare it to the gold price, gold is significantly undervalued. If gold were to return to its historical relationship with the money supply, we'd be looking at prices well above where we are now. Some analysts go even further. They look at the total amount of debt in the global system, both government and private, and they calculate what gold would need to be priced at to back even a fraction of that debt. The numbers are staggering. We're talking about gold prices in the tens of thousands of dollars per ounce. Now, do I think we're going to see $20,000 gold tomorrow? No. Markets don't move in straight lines. There will be pullbacks. There will be consolidation. There will be moments when it looks like the rally is over, but the underlying fundamentals are so strong, the forces driving this are so powerful, that the long-term trajectory is clear. Let's talk about what could trigger the acceleration. What could be the catalyst that takes gold from where it is now to 5 figures? There are several possibilities, and any one of them could be the spark. A major currency crisis would do it. If the euro were to face an existential threat, if Japan's debt situation were to spiral out of control, if emerging market currencies were to collapse simultaneously, the flight to gold would be immediate and massive. We've seen previews of this during various crises, but nothing on the scale that would trigger a true panic. A breakdown in the paper gold market would do it. If there were a major default on the COMEX, if physical delivery demands exceeded available supply, if the fractional reserve system were exposed for the house of cards it is, the repricing would be swift and brutal. Paper gold would collapse. Physical gold would soar. A major geopolitical event would do it. A conflict in the Middle East that disrupts oil supplies. A confrontation between major powers. A breakdown in global trade. Any of these scenarios would send investors rushing into gold as the ultimate safe haven. Or it could be something more gradual. It could simply be the continued erosion of confidence in fiat currencies. The slow realization that central banks have no exit strategy from their money printing. The growing awareness that the debt levels are unsustainable. The creeping understanding that the system is broken and can't be fixed. That's actually the most likely scenario. Not a sudden crisis, but a gradual awakening. A steady flow of capital out of paper assets and into hard assets. A persistent bid under gold that keeps pushing it higher, month after month, year after year, until one day we wake up and gold is at $10,000, and everyone is wondering how we got here. Let me tell you about the psychology of markets because this is crucial to understanding what's coming. Markets move in waves. They move in cycles. And right now, we're in the early stages of what could be a massive bull market in gold. Most people missed the move from $1,200 to over $3,000. They were too busy watching tech stocks or crypto or whatever the hot trade was at the time. They ignored gold because it's boring. It doesn't have a charismatic CEO. It doesn't promise to change the world. It just sits there, being gold. But that's exactly why it works. That's exactly why it preserves wealth over centuries while currencies come and go. Gold doesn't need a story. Gold doesn't need hype. Gold just needs people to lose faith in paper. And that's happening. Slowly but surely, people are losing faith. They see inflation eating away at their purchasing power. They see their savings earning nothing in the bank while prices rise. They see government spending money they don't have on programs that don't work. They see the system creaking under the weight of its own contradictions. And they're starting to ask questions. They're starting to look for alternatives. They're starting to understand why their grandparents kept gold coins hidden in the house. It wasn't because they were paranoid. It was because they lived through times when paper money became worthless, and they learned the hard way that gold is the only money that survives. Here's something most people don't understand about gold. It's not an investment. It's insurance. It's the asset you hold so that when everything else fails, you still have something of value. It's the asset that has survived every empire, every currency collapse, every financial crisis in human history. The Romans used gold. The Egyptians used gold. The Chinese dynasties used gold. Every civilization that has ever existed has recognized gold as valuable. Paper currencies? They have a 100% failure rate over time. Every single fiat currency ever created has eventually gone to zero. Every single one. The dollar has lost over 95% of its purchasing power since the Federal Reserve was created. The British pound has lost over 99% of its value since the Bank of England was established. These aren't failed currencies from banana republics. These are the world's reserve currencies, and they've been systematically debased over time. Gold, meanwhile, has maintained its purchasing power for thousands of years. An ounce of gold could buy a fine suit in Roman times. An ounce of gold can buy a fine suit today. That's not a coincidence. That's the nature of real money versus fake money. Now, let's talk about what this means for you personally. If you're watching this, you're probably already aware that something is wrong with the financial system. You've probably already sensed that the official narrative doesn't match reality. You've probably already started questioning whether your wealth is truly safe in the traditional places you've been told to keep it. The question is, what are you going to do about it? Are you going to wait until gold is at $10,000 and kick yourself for not acting sooner? Are you going to wait until there's a crisis and everyone is trying to buy gold at the same time, driving premiums through the roof and creating shortages? Or are you going to position yourself now, while gold is still relatively affordable, while physical metal is still readily available, while you can still make rational decisions without the pressure of a panic? I'm not telling you to put everything into gold. I'm not telling you to sell all your stocks or empty your bank account. What I'm telling you is that gold deserves a place in your wealth preservation strategy. A meaningful place, not 5%, not some token amount that makes you feel like you've checked a box, a real allocation that would actually matter if the system breaks down. Think about it this way. If gold goes to $10,000 and you don't own any, you've missed one of the greatest wealth preservation opportunities of your lifetime. If gold stays where it is and you own some, you haven't lost anything. Gold doesn't go to zero, it doesn't file for bankruptcy, it doesn't get hacked, it doesn't depend on someone else's promise to pay. The risk-reward is asymmetric. The downside is limited. The upside is enormous. That's the kind of bet you want to make when the odds are in your favor. Let me share one more story with you because I think it illustrates the point perfectly. There was a wealthy family in Germany in the 1920s. They owned property, they had money in the bank, they had investments, they were comfortable. Then hyperinflation hit. Within months, their bank accounts were worthless. Their bonds were worthless. Their cash was worthless. People were using money as wallpaper because it was cheaper than buying actual wallpaper. But this family had one thing that saved them. The grandfather had insisted on keeping a portion of their wealth in gold coins. Everyone thought he was old-fashioned. Everyone thought he was paranoid. But when the currency collapsed, those gold coins bought them food. Those gold coins bought them passage out of the country. Those gold coins saved their lives. That's an extreme example, and I'm not saying we're headed for Weimar Germany, but the principle is the same. When paper fails, gold works. When the system breaks, gold endures. When confidence evaporates, gold remains. The countdown to $10,000 gold isn't just about price. It's about the inevitable repricing of real assets against fake money. It's about the market finally recognizing that you can't print your way to prosperity. It's about the laws of economics reasserting themselves after decades of manipulation and intervention. The central banks know this. That's why they're buying. The smart money knows this. That's why they're accumulating. The question is, do you know this? And more importantly, are you going to act on it? The clock is ticking. Every day that passes is another day of currency creation. Every day that passes is another day of debt accumulation. Every day that passes is another day closer to the moment when the market says enough is enough and reprices gold to reflect reality. You can't stop what's coming. You can't change the trajectory of the global monetary system. But you can protect yourself. You can position yourself. You can make sure that when the repricing happens, you're on the right side of it. Gold at $10,000 isn't a prediction, it's a mathematical inevitability, given the amount of currency that's been created and the amount that will continue to be created. The only question is timing. And while I can't tell you exactly when it will happen, I can tell you that the forces driving it are accelerating. The central bank buying is accelerating. The geopolitical tensions are accelerating. The debt accumulation is accelerating. The loss of confidence in fiat currencies is accelerating. All of these trends point in one direction: higher gold prices. Much higher. So here's what I want you to take away from this. Gold isn't just going up because of inflation. It's not just going up because of uncertainty. It's going up because the entire monetary system is being restructured. We're witnessing the end of the post-World War II dollar-dominated order and the beginning of something new, something where gold plays a central role again. The institutions understand this. The central banks understand this. The question is, do you understand this? And are you going to position yourself accordingly? The countdown to $10,000 gold is live. The clock is ticking. The question is, what are you going to do about it?